Welcome to the Columbus, Ohio Real Estate News Show, where I dive into the stats and news that impact the Columbus, Ohio real estate market. Whether you're looking to make a move, invest, or just want to stay informed in the market, this is the show for you. I'm your host, Ryan Dieter with Key Realty, and you're in for a treat today because we're doing the 2025 market forecast for the Columbus, Ohio real estate market. So this one's going to be a little longer than my normal shows. But I do a deep dive into the data and trends that's taking place so we can make an educated guess on what's going to happen this year. We're sitting about halfway through January, which is typically when I do these shows. But it just kind of gives us an idea to kind of recap all that took place in 24 so we can look ahead to 25. So with that said, we got a lot to go over today. So let's dive in. All right, here we are for the market forecast for 2025. And I'm going to dive right into some data here and get this slideshow to work. There we go. I want to go back before we move forward, of course, and look at my 2024 market recap. This is to kind of give you an idea why you even should consider watching this. Kind of see where I landed last year. Some things I did well, some things not so much, but overall pretty close to what took place. So gives you an idea of kind of where I'm at, and you can actually go back and watch the whole thing. I think it's still on YouTube if you want to verify if this is what I said. But here's kind of what I recapped last year. So the number of homes, or sorry, this is what happened last year, not what recap, what I forecasted. That'd be the next slide. So here's actually what happened: is the number of homes sales rose 3.5%, which was down, but it was down 14% in 23. So that's where I want to kind of give you context of, yeah, home sales rose, but it was down 14% the year before. So not even close to making up what we lost last year. Median price was up, 5.5. Average price 5.2. Average price square average price per square foot 4.9. And days on market were up 31 days, up to 21% higher than last year, and are selling at 96.5% of homes original list price. That's down 1%. So um, we're seeing the market just essentially slow down as a whole, and inventory is up 21%, which shows that, hey, this extremely hot market we've seen the last few years has slowed down. And interest rates, of course, are a huge factor of that. And that's what kind of interest rates stayed higher than expected after seeing the rates come down at the end of 23. They hit the mid sixes, but then they climbed up to mid sevens again, coming back. Then they kind of came back down to mid sixes and are in the sevens right now. Depending on who you ask, there's a lot of factors of what the actual individual rates would be for individuals. So that's where we kind of say range on this stuff. When we talk about rates, there's always a range of where it could be. This is my conclusion of what I had last year. So kind of compare where we were last year. And I just copied and pasted this. I didn't come back and edit this at all. So you kind of can see rates will soften, allowing more buyers to enter the market, but still in the mid sixes end of the year. Kind of hit that on the nail. They're actually a little higher, mid sixes, but people are seeing mid sixes right now with good credit and low debt. You can easily get mid sixes. Fundamentals of real estate would be more important than ever, and that's easy to say. It's an easy kind of conclusion, but the last 5 years prior to 24, it really didn't matter. You could sell almost anything. Obviously, pricing mattered. People still didn't want to just overpay for things, but things did sell. People overlooked a lot of things during the COVID years because people got desperate and needed places to live. So it was a lot easier to sell homes. Didn't matter really the location. Every location seemed to be selling. Inventory was low everywhere. And so, that's not the case in 24. We saw location, condition, and market timing really be a huge factor, especially market timing. That's something people overlook a lot, especially in the Columbus market, where we really hit a wall once the spring market came to an end. Spring market came to an end, and we saw kind of a wall just go up when it came to buyer demand and home selling. It was a weird, like right in mid-June-ish, I would say, into the summer, we saw just kind of things slow way down. We still had a busy spring, which is normal, but a summer really slowed down. We saw that fall, be modest again as normal, and into the holidays kind of slow down as well. So, anyways, kind of that market timing was a huge factor in 24. Um, we'll see modest growth again, 3 to 5%. What did I say? 3 to 5%. Yeah. So, I was on the kind of on the conservative side of that, 3 to 5. We got to five. Essentially, I look at the price per square foot, median price, and average price kind of holistically. So you take those together and average those prices out. We're around that 5%. So I was a little more conservative as people still continue to buy homes. Neighborhoods will continue to see different results with suburbs continue to lead the way with established neighborhoods. That's very true. We'll look at that in more in depth here soon. Columbus will continue to fare better than the national market due to a strong population and industry growth. Once again, that's true. It seemed to we did better than the national market. I'll jump into that as well. We'll continue to see seasonal cycles in spring to be competitive and slow down again in the fall. Yeah, that market timing hit on that already. Interest rates are a single greatest influence in the market. If they get this was one of those if then things. If they get back to the 5 range, we'll see a much faster growth. But the opposite is also true. If they stay in the 7% range, we'll continue to see a slowdown. Yeah, and that's kind of what we saw. Really, it's a seasonal cycle. Market, the rates kind of came down in the spring a little bit, then shot back up in the summer to that 7% range, which caused the slowdown. One of the reasons why we saw a slowdown as well. Here's the numbers by up to November. I'm going to focus on the year to date. Again, we're looking at November because we don't have the full year to date, but this is the 11 out of 12 months year to date we're going to see. So it's very, very close to what we'll see overall when it comes to percentage wise where we're at. Average price being that 350 range, median price close to 300, and average price per square foot 193 there. You're seeing, days on market up overall through 27%. In November, we're at 31 there. So compared to last year. So things are on the up. So Columbus did, you know, see a modest growth. This is saying 5.8% according to the FHFA House Price Index, which is a little higher than what Columbus Realtors is showing. There's always this confusion of how Columbus is measured, whether it's Columbus region or Columbus City, or the city itself of Columbus or the Columbus region. The MLS data is going to be the Columbus region, and I'm not 100% sure what region this is, but at the same time, or what this all encompasses of when it comes to the area of Columbus, because the MLS, which is this data here, is going to be anywhere that the MLS, anyone that's on the MLS. This can even include some of Springfield out to Zanesville, which I bet this is more closer to the Columbus metro area. So that just shows, which makes sense why this would be higher. So you can see here the top 10 cities of growth this last year in 24. This is based on Q3 up to Q3. You can see Dayton did make the list of Ohio City, and Columbus is number 39. So you can kind of see this is so in that range, Columbus is 39 out of 100. But you can see on top of this range, Miami is probably one of obviously one of the bigger cities. But we saw some big cities actually take the East Coast here, and then you have Anaheim, of course, as well. But here's the bottom 10. So you did see some negative depreciation in some major cities and places like San Francisco, Oakland, and even Austin saw some setbacks there when it comes to pricing. Some cities that saw a lot of growth the last 10 years, 10 to 15 years, saw some slowdowns, even some depreciation as a whole. So the fact that Columbus still rose 5% with a lot of these cities that had a lot of growth in the last 15 years, like Columbus did, shows that Columbus is a little bit more stable, more resilient than some of these major cities that we're seeing on here. Here's just a chart of what took place over the last 10 years, 10, 11 years now. You can see the seasonal cycles, and this is why understanding seasonal pricing really matters. But you can see, we still hit an all-time high when it comes to median price this last year, close to that 360 range, and then came back down there. Okay, this is a map comparing the median sale prices of the United States up top. I know it's a little distorted, so just bear with it there. I wanted to fit it on the page so you can see it. But yeah, this is a map of the last 5 years or so, just over 5 years, of what pricing has done nationally versus Columbus is the bottom here. You can see Columbus is a little bit more steady up to the right, where the national had a little bit of a peak back in 22 and then came down, actually had a little more of a correction. I think Columbus, saw a little bit of a correction, but still had that appreciation growth. Never truly had a year-over-year depreciation in the last 2 years, which is a really, testament to the Columbus area as we saw, us outpace the national landscape. Again, here I like to show this chart. It just gives big long-term perspective of what's taking place in the market. From 1970 to 2024, 25, we're seeing, this is the average price of or median price of homes in Columbus. And what you can notice here, if you actually drew a straight line from 1970 to today, it'll be a nice steady growth chart. It's just, we had in 2008, we had the largest depreciation event in the history of the market. And I think in 2000, we can call it 2000 to 2005, or really 2019 to 2023, we saw the greatest appreciation market event in the market history. So just kind of taking those two events out, you kind of have a nice straight line there. Kind of the over, you had the depreciation and the overcorrection. It would have been nice and steady if it didn't. Neither of those events took place that caused those events. All right, enough looking back. We're going to look forward now and kind of make my prediction of what I think is going to take place in 25. So there's really five major things that I'm looking at. And I kind of broke this down. My last year's was a little long and I went pretty deep into some stuff. So I wanted to kind of keep this one a little more brief. And so I broke it down into five things that I really want to focus on. Of course, interest rates are number one, buyer demand is number two, population growth, inventory, and affordability. What I always tell people is that real estate is not rocket science. It comes down to supply and demand. And there's a lot of factors to supply and demand. But bottom line is if there's enough demand, if there's more demand than supply, we're going to see a seller's market. And the latter is also true. If there's too much demand and not enough, or sorry, too much supply and not enough demand, we're going to see a buyer's market. And so that's kind of the gist of the real estate world, but understanding how to find, figure out buyer demand, how to understand where the supply is and what the supply is doing. It's a little more nuanced to that. And that's what I kind of want to dive in today for you. So interest rates. Now, again, we talked on this earlier. The interest rates have kind of settled in that 6 to 7% range. I kind of think that that's where they're going to stay. I think, but a lot of people have kind of accepted this. They've just kind of said, yeah, this is the new normal. That, it's the days of 3% interest are behind us and they may never come back. We're hearing that all over. Don't expect 3% rates anymore. So, that eventually that's going to sink into people and they're saying, hey, if I want to buy a house, it's going to be at a 6% rate. There's nothing I can do about it at this point. I've waited long enough. I need to buy a house or I need to move up, and it's just going to be 6 to 7%. Now, there will be buyers that already own a home that decide to stay in their homes longer because of those rates. But those who don't have homes or their homes are just not working for them, the pain is going to be enough to finally bite the bullet to say, hey, we can take on that 6% interest rate. Um, Again, moving forward in 25, it's kind of mixed reviews what will take place. With the new administration, the biggest thing, there's just not a whole lot of clarity on what exactly they're going to do. They've touted a lot of things. They've thrown out a lot of things. Obviously, tariffs are a big thing. Deportations are a big factor of this. And tariffs directly impact the bond market, which will impact the mortgage rate. The Federal Reserve, everyone's watching the Federal Reserve when it comes to mortgage rates, but it really doesn't, correlate exactly with mortgage rates. The bond market's actually closer tied to mortgage rates than anything. And so, tariffs have a direct negative impact on the bond market typically. So that's something just to be aware of as, if there are large tariffs put on, that there's good chance that could actually increase mortgage rates. And the same thing with deportations. There's a large, I don't know the exact number, but I've heard, don't quote me on this one, about 40% of the building industry's workers are undocumented immigrants. So, if there's a large deportation taking place, that's a big number of workers that will not be able to do the work on houses. Now, I think, there's a lot of positioning when it came to what, what the new, Donald Trump said he's going to do, to what he actually is going to do. We'll see. That's where just everyone is. They're in wait and see mode because of that. So I don't want to dive into that too much, but that's kind of where people are. So I expect a couple rate cuts, maybe. I kind of expect one rate cut from the Fed, but it will really not influence the mortgage rates a whole lot this year, in my opinion. I think they'll be kind of flat, kind of where they are is what we'll get. They'll come up, probably in the summer like they did last year, just because we see spring market tends to see more influx. buyers, when we see people start buying, that's when the Federal Reserve and mortgage companies say, okay, people are still making decisions to buy. We can actually increase rates a little bit to keep inflation from taking place. We don't want, inflation because they're really afraid of inflation right now. That's their biggest fear is the inflation number, mortgage companies and the Fed is. And so if houses start flying off the shelf again, like we've seen it the last few springs, they're going to want to tighten that up a little bit and try to slow it down so inflation and housing prices don't get out of control. This is the past 5 years of rates. You can see here the low at 3%, how much they shot up. And now we've seen since 22, really, we're now almost 3 years into higher rates. We will be this summer. So 3 years is a long time for, a lot of new people, a lot of people that were not even thinking about buying a house in the last 3 years, who, never had the opportunity of 3% interest rates are now entering the market. So which will make an influence of that. Here you can just see the direct impact on, mortgage applications versus mortgage rates. I think the blue line here is the applications to rates. And so this is provided by Mortgage News Daily if you want to see these numbers yourself. And on that note, all these charts and data, if you want the information, please reach out. I'm happy to share my resources with you as well. So one thing to point out is that the Freddie Mae home purchase sentiment, which is kind of where buyers they survey a bunch of buyers, say, hey, how likely or how much desire do you have to buy a house? For the first time in the 4 months of improvement, which we've seen in 24. Let me go back here. We've seen improvement in 24. So the first time we actually saw it come down a little bit uh, to end of the year at 73.1%, well above the 67 mark we posted in December of 23. So we are higher than we were last year when people were saying consumer confidence in buying a house is basically what this is. So we started the year and looks like we start the year at 70% in January. However, it lost some positive momentum at the end of 24. So, overall, I think the end of we saw actually after the election, a lot of people were just waiting to see what took place. There's a lot of uncertainty with elections. So we saw buyer sentiment rise from that. All right. The next one is population growth. Obviously, again, supply and demand, more people moving to the region means more demand. And so, population growth has been steady the last few years. Now, there's been a lot of kind of estimates on this, and there's not really a lot of good data. Obviously, the Census Bureau tries to get an idea, but honestly, this data is hard to find a good exact number year to year. Every 5 years, they try to do this, so it's easier those years. So 24 has been really difficult to see what exactly happened. They've been typically predicting between 1 to 2%, about 1.5% of population growth. But I read a couple things that saying, hey, they think that maybe it's slowed down here in Columbus, but it's hard to say. They did a study that most of Ohio is losing population. Besides the Columbus region, the Central Ohio region is the only one that's really gaining population over the last 5 years or so. So which is no surprise of what's taking place in the state. So with that said, Ohio ranked the top 15 state in America people are moving to. And I think that's really just, obviously, if that stat's true, where most cities and areas are losing population, then, Columbus, has to have strong growth if it's still in the top 15 states to grow to, or of growth, according to U-Haul. And U-Haul is ironically, is one of the best data points that people have when it comes to people moving. They just use their data of who's renting their trucks and where they're moving to. And so we can see here they actually track on states. So the most residents that are moving both to and from Columbus are Florida, Texas, and California. So roughly 33% of all move outs. And this is 22, obviously, so the data is a little behind. But you can I'm sure it's very similar to what it is in the last few years. So those Florida, Texas, and California movers are both moving in and out. 33% of move outs and 30% of move ins are from those states, which is kind of just fun little data. And you can see here, this chart here showing where we are, projections, kind of that blue, and then kind of the median or the margin of error, is that gray. Kind of that you call it confidence limit. So it could be better than what they're saying. It could be worse. My guess is that it's slowed down. We've seen a lot of the major kind of, obviously I haven't got this far and haven't announced and said anything about Intel yet in this uh, forecast, which is, Columbus in the last few years. You can't get too far without talking about Intel. So, but we've seen a lot of things slow down, take place, and especially in regards to a lot of the big developments taking place here in Columbus. So, my guess is that it has slowed down as well, just from my understanding of what's going on in the market. But here, you kind of see the projections of growth as well. Um, but yeah, so births and people moving to Central Ohio, and in migration, people moving from Ohio to Central Ohio, Columbus area were the most people contributing to the region's growth in the past. However, Central Ohio, like a nation, has shown a continued trend of increasing death rates and lower birth rates. This trend is due part to the aging population, making it even more important to welcome new people to our region. So that's where I think the population growth has slowed, even though Columbus is still getting people moving in from other areas. All right, so job growth obviously spurs population growth as well. And this is something that job growth actually has slowed down and is not keeping up nationally. And this is something that's a little concerning when it comes to the Columbus region's growth. That's something I think that people need to keep an eye on as a whole. So you can see here, this is as a whole, we've only added 4,500 jobs as a total because we've lost a lot in certain fields and we've gained some in others. So we're really kind of net neutral when it comes to, gaining jobs. 4,000 is not very many. And so, that's, if you have 4,000, good jobs, maybe you're getting, you know, 2,000, to 3,000 people moving here for those jobs, or just people that need jobs in the area that will take them. So, anyways, you can see the total construction and mining were the top, kind of where we did well at. Not surprising, healthcare, private education, and government here. Those are the three major things that we're doing, I would say. But you're seeing manufacturing's down, retail's down. Retail has always been a kind of a big part of Columbus's area, so seeing that's down. Is interesting. So you can kind of just get a whole picture of the job growth here in Columbus, which is going to actually slow down the population growth, in my opinion, and also with less job creation and less wage growth as well. We'll talk more about that. All right, hitting new listing and slash new inventory. Again, it's the supply part of the supply and demand equation here. The inventory was up 21% compared to last year, but still less than the pre-pandemic numbers. That's where you're going to see here a lot of, hey, inventory's up, but it's still less than pre-pandemic numbers. That's how much, even though it's up 21%, that's how much it's decreased in the last 3 to 5 years. Is that it can jump 21% and still be less than it was in 2019. So again, obviously high interest rates have affected this, making it harder for buyers to buy. So there's less buyers in the market. I mean, in 21 to 22, I mean, we've probably had 20 buyers at every listing, which is just absolutely insane. I mean, that's not sustainable. It's not healthy for anyone but the owner of that house. But that owner of a house probably needs to find another house. So basically, unless, the person just, is moving to a nursing home or not needing another house, that's the only person that really benefits, which is very few and far between. And so that's not a healthy market. If you reduce the amount of buyers by, say, you know, you have two buyers at every house, that's reducing a lot of the demand in the market, but still having a very strong, healthy seller's market. And so that's a lot of buyers that can leave this market, like say, hey, I can't purchase a house, or I don't want to purchase a house in this market anymore, and still have a very strong seller's market. So just because inventory is up and buyer demand's down doesn't mean that this is a buyer's market by any means. And we're going to talk more about that, but that's just something I want to get clear, that we're not seeing deals all over the place right now. Um, Owners that have low payments and high equity are still you know, there's very few desperate sellers. There's not people that are looking to sell their house for a deal. They'll sell their house for the right price, and they'll get a good amount of money. If not, if they don't sell it to a price they think it's worth, they can take it off the market and hold it. They can figure out a way not to sell it. That's where new listings and inventory are trending up as a whole, but not in all areas. This is something that's really fascinating about 24. Something that I really am focusing on in 24 and moving forward. I think it's going to see the same trends. Something to keep in mind is that Columbus, Ohio, and the areas are not all equal when it comes to the housing market right now. As if you look at the 21% of inventories rising, certain areas are seeing even higher than that. They're seeing close to 50% inventory rises, where some areas are actually seeing inventory decreases. So that's where, you're seeing some areas like Worthington, Clintonville, and some areas that are, very strong markets right now, that very few houses on the market, we're actually seeing less inventory. So that's where then you're going to obviously, of course, to offset that, if a number is up 21% as a whole, you're going to have areas that are, have a lot more inventory. Like the South Side, we're seeing that right now. The South Side has a lot of inventory available right now in the actual and that goes with the appreciation growth as well. Appreciation growth in that area is not strong. If you have a lot more inventory in an area, appreciation growth's down actually in those areas. Appreciation's up quite a bit in some areas that have less inventory. So again, it's that supply and demand. Inventory is a huge factor of that. And the Columbus board breaks this down to where you can see the inventory per area. So this is a very important little data point that it's useful for you if you're looking to buy in a certain area, or you want to get maybe you're looking to invest or want to get a deal in a certain area right now. Those areas that are really hot, that really took off in 20, I think 20, 21, that just like almost just skyrocketed, even like early 2018 to 21, those areas somewhat have slowed down and as a whole. And so you're seeing more inventory, seeing a lot of places where flips were taking place. The flip, where a lot of investors and flips took place, we're seeing those areas slow down as a whole as well. So keep that in mind. Um, the inventory, people are living in their homes longer still, up to 13 years. It was 10 years in 2008. It was 5 years in 85. So it's just, and it's not surprising. People are, lower interest rates, less kids per household. It's just, it allows you to stay in your house longer, but also, with those lower payments will keep you in your house longer as well. And lastly, people are, I think I talked about this last year as well. People are becoming accidental landlords where instead of selling their house, they're realizing they can rent it out or, Airbnb it and make money, to offset the higher payments they may have on the new home. Um, Seeing that quite a bit. New builds. New builds, again, new inventory. I kind of want to put this as part of the inventory issue. As long as it costs more to build a new home, and existing prices will remain steady. So that's something that's, hey, as long as we can't, there's population growth, there's buyer demand, and a new home still costs more than an existing home, you're going to see existing home sales, prices continue to be steady. And the average new build right now is close to 500,000 in Columbus. It's $500,000. That price point is kind of just, 10 years ago would have been, outrageous to somebody. Um, it's kind of hard to believe that $500,000 is the price of a new build. There's a lot of factors of that, the cost to build, just the competitive pricing. But there's, and just what people are building, they're building bigger homes as well. And so that makes the average price a little higher. Since 2020, the region has added 1,100 housing units per year. This is rough estimate. Um, Growth projections grow. The region needs about 15 to 16 hundred units a year now. So we're still lagging behind what the units are needed. And I'm going to show you a chart here that's going to show you we're lagging behind what's needed to make up for what we didn't build in the last 15 to 16 years. So and so here's a good chart. So the household increases versus building units. So you see the black line is the household increases. The blue line is uh yeah, sorry, the house is built. Sorry, I got that backwards. The black line is the houses built. The blue line is houses increases. So you can see what happened prior to 2008, that we built a ton of houses and we didn't look at the data to say, hey, we're building a lot more than needed. And then we saw those households really, then the market crashed and people couldn't build those houses. A lot of builders got in trouble because they built so many houses they couldn't sell. And so you're seeing here actually on the back end that we're actually building enough houses if we didn't have these 10 to, what are they saying, 13 years here of lack of building. And this is, one thing that I'm looking at watching closely because I'm interested to see supply and demand of new builds as the every year goes on. Are these new builds being sold? Even though we're building more than what, if you took it in a vacuum year over year, we're building more that's technically needed for this year, but because of the lag, they're building extra. And I'll be interested to see if we're selling this. Now, I have seen, things open up in the new build world, and there's a lot of factors of that, but new builders are doing more, incentives to get buyers in there. they're wanting people to kind of advertising more and things like that. And we're seeing units actually sit longer. In 2021, 22, they couldn't build them fast enough. They couldn't even show you houses. They were selling them before they even broke ground so fast, and they got in actually trouble because they sold too many. They couldn't build for the buyers. So this is something that's really interesting to see moving forward, how this will impact the market and if they actually build too much and we get inventory sitting in the new build world. Right here on my face here, so you can see this. This is the new building permits in 24. So this is something I'm seeing. The permits is basically a good way to predict how many homes are going to be built because they have to do permits before they can even break ground. So, all right, as you can see here, we're at the low point in permits, which kind of gives us an idea of what's going to take place in 25. That we're going to see a slowdown in building, and I'm not surprised by that as we see. I've seen, a little bit more new builds sitting in the market. New build sales are trying to reach out to agents more, and we're just seeing, inventory rise again. In 21, they built so much they couldn't keep up with their demand. Uh, we're seeing them slow down now. They don't want to get in a bind here and build too much. This is kind of a good shot of where we are as a whole in permits for single family. So you're seeing, I think the permits are probably up even higher. You can see that 800, here, go back, 800 on the chart. Is a little bit higher as a whole. This is for multifamily and single family, and this is just for single family. So you're seeing this, is down compared to where it was in 2004 to that 2005 when it hit its peak. So keep an eye. All right. Affordability is always a big factor when it comes to what people, the buyer demand. The more affordable an area is or housing is, the more likely you have more buyers. So cost of living is always going to be an issue, and what's going on outside of housing, of course, is going to impact all this. Um, but in October 24, median sale price was about 315, which is 26% lower than the national median. So it kind of gives you an idea of where we are nationally, about 25% less nationally. Um, it's across the board, Columbus, so it's still less expensive market than a lot of areas. Columbus home prices have increased 47% after inflation over the past 5 years, compared to 30% nationwide. So, even though we're still less, we have seen a faster increase compared to the national percent. So that's something to be aware of, that Columbus housing prices have jumped faster. And so we're getting less affordable compared to other markets. And that is something that's concerning because something that makes Columbus, a great place is the affordability. And this is, I always talk about Columbus, we don't have mountains, we don't have ocean, but we have great communities and affordable living and, easy access to the city and to neighborhoods. So those are things that we gotta hope that they stay that way as well. So if we get less affordable than these or just as affordable as some of these major cities, it gives less people reason to want to be here outside of, family and jobs and things that they can eventually decide to move on from. Um, the cost of living is 10 to 12% lower on the national average. That's just cost of living, and this is overall 10 to 12%. So this is that was one stat. This cost of living pay scale. Here's a chart that I found saying we're overall 6% less, 8% less. So this is it's always hard to tell, kind of picking data from different sources, but you kind of look at a bunch of different sources and kind of come to a conclusion that yeah, it's still less than in most places. But we're getting caught up to the average in the country. I like this little chat. I've been showing this the last few years. There's a link here if you want this chart yourself, but this is where the Columbus average salary in 2025 is close to $90,000. It's a pretty good salary for a major Midwest metro. Here's mortgage rate. This is kind of where if you got a 6.5% mortgage rate, which is down a little bit. It's saying your monthly you can find an average home, which is the 330, seven. Your monthly payment would be about 2,000 on that, and your salary. That's with the salary. So Yeah, so it's a nice little chart here for you guys just to see. You can raise it by 10% here. That's if you put, 5% down, I believe. 10% down, you're going to increase that buying power, obviously. In 24, you can see the difference here that they said. So 24, salaries were roughly the same. I kind of put both these on here just so you compare it to 24. The salaries went up just a hair, not much, but the thing that made a difference here, and where you can actually buy just as much house because interest rates have come down a little bit so the average interest rate was 7 last year. So not much different than last year. That's is a concern that, if pricing is going up by 5% and uh, average salaries are not going up at the same rate or even higher, it's gonna be harder for the average person to continue to buy a home. Rent prices are another huge factor. Our rent prices increasing, which they did not this year, and as a whole across the country they did not. Some places even saw rent decreases. So the really rents were really flat this last year. And it comes to the average rent. Now I do think single family rentals are up as single family rentals are getting harder to find. As inventory gets tighter, we're seeing less homes. Even though people are renting homes out to kind of offset, we're still seeing less homes, I think, in the market, or you're just seeing less people moving if you have a single family rental, so less inventory is opening up in a sense. Um, and keep in mind, this is the average. The average size apartment. This is an apartment. This is a single family. Is they're saying it's 666 square feet. And the average rent's over just over 1,100. This is not including, this is not just single family. In my opinion, single family is much higher than the average rent, 2 to 3 times as much, depending on what location you're in. And so that's where we're seeing rents increase in single family housing, and we're seeing people get to the point where, again, if they can't buy, they can't buy. But if they can buy based on, down payment and your credit score and debt to income ratio, that it's getting close to still owning a house is still cheaper. Now it depends on what area you want to be in. Um, Certain areas are going to be tough to you can move out of a higher end area into a lower end area and own a house for the same cost, but it's still very difficult to be in the same area one for one, where if you're moving from one area to the next, you can find homes that may be just as much as rent when it comes to mortgage payment. So that's the thing. So it's still cheaper to rent, and people are, trying to save as much as they can. Inflation's a huge factor of that, trying to help, but less people, I think, these last few years have been able to save money for down payments. All right. According to WalletHub, Columbus is still the 17th most affordable large city in the country. And I say large, this is actually I think all cities here. And you can see, Montgomery, Alabama, Flint and Toledo, Detroit, Akron, Warren, Michigan, and Pittsburgh's probably the closest to Columbus that we get on the list. And really, reality is that, you look at this list, and I'm not sure where Surprise Arizona is, but otherwise, Columbus is, when it comes to what Columbus offers to what you get in a city, Columbus is one of the best on this list, and why people are still, here in Columbus, why Columbus is still, a more stable market, in my opinion. All right, other notes that just to kind of keep, I'm not going to dive into today, but just things that impact the market, I want to just point out. There's new zoning that took place in Columbus. It's a start that they're trying to make higher density corridors in Columbus, which will add to the housing supply, hopefully, and allow more affordable housing to be built. So that's something that's taking place. They're trying to push, even more density as a whole, which any adapting city is going to have to, accept. You can't have you can't have population growth and not build density. It's just, it's not a great income, it's not a great recipe for thriving neighbors and thriving community. It's going to just widen the gap between the have and have nots, and you're going to keep people from moving here as well. So cost of additions and custom building, that's something that matters. Additions and construction costs have, along with housing prices, have also doubled. And so even though, people want to stay in their houses longer, they want to, okay, maybe I just, instead of moving, maybe I do an addition. That cost has increased quite a bit as well. So it still seems to be, it's not, I want to say cheaper or not, but it's maybe a better investment per se to buy a house that needs fixed up than to do an addition, a full addition where you're busting out walls and things like that and adding on to a house. Cost of rent, I think you talked about that, but also cost of all other goods. Again, inflation and matters. Can people save for houses? Are people, spending money on groceries? And they can't get ahead of their savings. I know a lot of people are in that situation where they have, their car breaks down one time, and there goes all their savings. And then income increases. Our incomes rising faster, or at least steady compared to prices. So, all right. So my conclusions. This is what you've all been waiting for. Thanks for hanging in there. If you jumped ahead, good for you. Found the cheat code. But here in 2025, my market forecast conclusions are rates will remain the same, give or take 5%, or 0.5%. Sorry, I wish come down 5%, but give or take a 0.5%. More buyers will stop waiting for rates to drop. I think more buyers are going to enter the market as they get tired of saying, "Hey, maybe rates will get back in the fives, and I'll make a decision." But they're going to find a way to get in the market if they've been waiting for those rates to drop. Again, I think this is the same line I had in my 24 conclusion, because I wholeheartedly believe in this, that the fundamentals of real estate will be more important than ever. Not maybe not than ever. They're just more important. I think these next 2 years maybe, where people have thought that their houses are going to fly off the shelf just because it's Columbus, Ohio. It's a hot real estate market. They see some headlines that it's the best in the country. All the country has slowed down, and so this still matters. Location, condition, and market timing still is a huge factor in getting your house sold and or getting a good price on a home if you're looking to buy. Um, we'll see modest growth again, 3 to 5% as a whole, but not all areas will be the same. I think, I say modest. I can even see that being higher. I think 3 to 5% would be about right, because we're seeing some areas have higher inventory, and it'll be some lag from areas, and there'll be really strong growth in other areas. Areas that have good school systems, established neighborhoods that have a lot of walkability and character to houses. We're going to see those become, really desirable areas. We've already seen it, and so I think that's going to continue to be the trend. Areas that are really competitive right now are going to continue to be competitive. Areas that are not competitive right now are going to continue to be a little slow when it comes to sales. So Columbus will continue to fare better than the national market. I think we're going to still continue to be better than the national market. I think the national market will pick up some, as we saw, the national market kind of be flat this last year. I think it'll start to see growth as well. Again, as a whole, across the country, the fundamentals of location, condition, and market timing will be a huge factor. We'll see the spring cycle. So if you're looking to buy, the spring cycle will be competitive again. If you're looking to sell, the spring cycle will be competitive again. So that's something just to be aware of. If you want to get top dollar, spring is your time. If you want to, avoid multiple offer situations on good homes, the spring is not your time to buy. And so, kind of finding ways to avoid the spring as a buyer. And, if you're looking to sell, the spring is the best time. So keep that in mind. Interest rates, again, will continue to be the major factor. What's the new administration going to do? Will it impact interest rates? Will it not? That's what everyone's waiting to see. Kind of this, as there's a lot of uncertainty in the air right now, but there's a lot of optimism. I think there's a lot of optimism of like, hey, things are, stabilized, whether they're, where we want them to be or not. They're at least stable, and we can move forward knowing that there's some security that it's stable. And maybe what your interest rate, or they can look at the numbers and say, hey, this may be the worst it'd be, and we can still hopeful that rates will come down and maybe refinance in a couple of years. But at least we know things are like somewhat stable. Prices are not skyrocketing. For buyers, that's a great thing. That if you are trying to save, that prices are not going up at 10 to 20% a year. So you can, maybe get ahead of the curve and try to save for a down payment and plan to buy eventually. So anyways, hopefully this is good news for you. If not, love to hear what your thoughts are on the market. Love to get your comments. And if you want to just have a chat about the market, always happy to have those conversations. Thanks for tuning in. If you like this information, please subscribe to this page. I try to do information that's useful for you, but not just flashy. I try to make it, stuff that you can take home, you can kind of use, and not just, be, kind of the headline. I like to dive into things and kind of use logic and reason and data to make decisions. So help you make decisions as well. So please like this, subscribe this if you're one of those people that like actually to make an informed decision. And always happy to have a real estate conversation with you. Have a great day, and I will see you next time.